Welcome to what is truly the best trading course out there. In this video, I will lay out all the main principles of trading on the financial market. By watching this video, you'll save a ton of your time because it contains everything you need to start making money trading binary options. By consistently applying these trading principles, you'll eventually be able to start earning from trading, just like I do. The information in this video is suitable both for those who are just starting their trading journey and for those who have been trading for a long time. But if you don't want to learn and make mistakes along the way, I have a great option for you. In my Telegram channel, I provide trading signals. I tell you where, when, and for how long to open trades, and you simply follow along and earn with me by copying my trades. You can find the link to the channel in the pinned comment below this video. Hurry up, while joining the group is still completely free. So, the first thing we'll cover is candlesticks. What do they actually mean and how do you read them? Candlesticks can be bearish or bullish. Bearish candles are red, indicating a downward movement, while bullish candles are green, indicating an upward movement. Typically, various candlestick patterns are identified. These are combinations of candles that tend to repeat themselves in the market and can be used to determine the future price movement. But in practice, it turns out that in many cases, they don't work because judging solely by candlestick patterns is like judging a movie by a short clip from it. It can tell you everything or nothing at all. It is much more important to observe the behavior of the candles, their size, volatility, reactions at certain levels, and so on, and to draw conclusions about the future price movement based on that. We will talk about this a little later. For now, let's cover the basics. The next thing we'll discuss is the trend, that is, the direction in which the chart is moving. A trend can be either downward or upward. It can be short-term or long-term. They can also be referred to as local and global, respectively. To determine the trend, you need to zoom out on the chart and look at its lows and highs, or as they're also called, the lows and the highs. These are the points where the chart changed its direction. If the highs and lows are lower than the previous ones, it's a downward trend. If they're higher, it's an upward trend. Determining the direction of the trend is necessary to understand which direction is safer to open a trade and which level the price will be aiming for. Let me give you an example from the chart. First, let's determine the direction of the long-term trend on the 30-minute time frame. Then, on the 5-minute time frame, we'll look at where the short-term trend is headed. They match in our case. From this, we conclude that the price is most likely to go down, but we don't know how far and from where the chart is most likely to move. To find this out, we'll study such an important concept as support and resistance levels. Finding them on the chart is no harder than identifying the trend. Levels can be horizontal or diagonal. To find horizontal levels, we need to draw horizontal lines from the points of maximums or minimums. Levels at the maximum points are called resistance levels, and those at the minimum points are called support levels. And the more minimum or maximum points there are at a level, the stronger it is. For example, this is considered a weak level because there was only one price reversal from it. And this is a stronger level since the price bounced off it many times. Levels can also turn into zones if several levels can be identified close to each other. In this case, the price may react to any of the boundaries. Now let's talk about diagonal resistance levels. They are identified and work according to the same principle as horizontal levels. Here is an example of such levels. Levels like trends can be global or local. Global levels are identified on the hourly or 30-minute time frame. They are generally stronger, and it is harder for the price to break through them. Local levels are marked on smaller time frames, for example on the 5-minute or even 1-minute chart. It is much easier for the price to break through them, so in some cases, they can be used to open a trade at the best possible spot. For example, after a small pullback from such a weak level. Let's return to our situation. I'll mark the global levels as well as the local ones. We can see that after retesting the local level, the price approached the diagonal support level, and now it can either break through it or bounce off and go up. Observing the behavior of the candles will help us figure this out. This is a very important aspect of technical analysis. By the behavior of candles, I mean their reaction to levels, their shapes and sizes compared to previous ones, changes in volatility, and so on. All of this allows us to understand where the chart is most likely to go or whether the level will be broken. Let's return to our situation and make a final conclusion about the direction of the price movement and when it will happen. First, let's pay attention to how the price has reacted to the level up to this point. We see sharp approaches and equally sharp pullbacks. Now, however, we see that the chart is approaching the level quite smoothly, and the candles are not volatile and are roughly the same size, which means that previous reaction to the level is no longer present. Therefore, we will work on a breakout of the level. We also see that the price has stopped reaching the resistance level, and the highs are actively decreasing, which again indicates a further breakout of the level. To determine how far the price will go, we need to draw the new emerging channel. Here it is. Now we know from where the chart is most likely to move. Let's suppose we opened a trade right here. Naturally, I won't be opening any trades right now, since the situation I'm analyzing is just an example to explain the basics of technical analysis. You can see how I actually trade in my other videos and reinforce the knowledge you've gained. So let's get back to our chart. We can see that a breakout occurred and the subsequent movement follows the analysis exactly. Therefore, we would have made a good profit from our trade. I'd also like to mention something else that I often use in my trading. That's Elliott wave theory. This theory describes market movements as waves that often repeat themselves. Here you see the essence of Elliott's theory. It's a wave structure consisting of 8 waves, which repeats itself on the market in various forms. This is its general appearance. For example, it can be inverted. There can also be several waves within a single wave. Knowing all this, we can make assumptions about where the price will go. Let me show you how all of this looks on a chart. Here is the first wave, the second, the third, the fourth, and the fifth. And then wave A, B, and C. By noticing the formation of part of this structure on the chart, we can, with a high degree of probability, predict the further movement of the price. This theory will also serve as a good confirmation or refutation of your analysis. I would also like to mention the site where I trade. This is the best and most popular broker, Pocket Option. It has a pretty intuitive interface as well as fast deposits and withdrawals. Overall, based on my trading experience here, I can say that I am definitely satisfied with this broker. So that you don't run into scammers, I'll leave a link to the official website in the pinned comment under the video. If the site doesn't open, use a VPN service. I'd also like to talk about the site where I analyze the market. That's TradingView. It's much more convenient to do analysis here than on Pocket Option. Here, it's easier to switch between timeframes, zoom out and move the chart, draw, and so on. I analyze the charts here, but I open trades on Pocket Option. I'll leave the link to TradingView in the pinned comment as well. Let's move on. Do you see these movements? To avoid encountering them during your trading, you must always check the economic calendar before starting your trading session. Now I'll show you how to use it. If you scroll down, you'll see the names of currencies and next to them, stars and times. These stars indicate the importance of the news. News with 1 star doesn't affect the market at all. We are interested in 2 and 3 star news. News with 2 stars won't cause strong volatility, although they can lead to short-term unexpected movements on the chart. But news with 3 stars is often accompanied by such unpredictable movements. So, if you're planning to have a trading session, but you see in the economic calendar that 3-star news is about to be released, I recommend refraining from trading during the news release. I'd also like to talk about another important thing, overlap. Whenever you're not sure that you've entered at the right point and you think there might still be a pullback in the opposite direction from your predicted movement, and only after that the chart will go where you expect, you should identify a point for yourself from which you'll open a trade that will cover the loss of the previous one and allow you to earn extra on top. The amount for the covering trade should be 2 or 3 times larger. There can be several covering trades, but if you see that the chart isn't moving in the direction you predicted and your analysis is incorrect, then it's not worth making any more covering trades on this currency pair. Let me show you an example on the chart. For example, we opened a trade here for an upward movement, but we didn't take this resistance level into account. So, we need to mark the level to which the price is likely to pull back before moving in the direction of our analysis. This is this support level. So from this level, we open a trade for an amount 2 or 3 times larger in the same direction. And as we can see, now our trade would have ended up in profit, and as a result, we would have recovered the previous loss and even made some extra profit. There may be more than one overlap, but if there are already more than 2 or 3, you should consider whether you analyze the chart correctly. If you use overlaps wisely, it will be almost impossible to lose. It's simple math. The more overlaps you can open, the less chance you have of losing money. I hope this video was useful for you and that you absorbed the information from it. If you didn't remember something, I recommend re-watching this part or the entire video for better understanding. I hope this video deserves your like and a subscription to the channel. On my Telegram channel, in addition to signals, you can find even more useful information about trading. There, you can also earn money under my guidance, simply by following my steps. Let me remind you that I left the link to the channel in the pinned comment. I wish you good luck and look forward to having you on my team.